concepts for trading stocks, crypto, forex, or any other financial market. By the end of this course, you will not only be able to trade smart money concepts correctly, but you will also learn about multiple smart money concept techniques that most traders don't know about. Alright, so let's begin here by talking about what you can expect to learn from this course. And the very first thing we need to cover is, of course, what is smart money concepts? Or in other words, what is SMC? In order to trade smart money concepts, it's of course very important to have a solid understanding of what it is in the first place. Next, we are gonna dive into some very important market structure concepts. We will learn about something called change of character, or for short, CHOCH, and we will also learn about something called break of structure, or for short, BOS. These two concepts are very important and they are fundamental to understand if you want to trade smart money concepts. In chapter 3, we will cover yet another important concept, and that is strong and weak price levels. Strong and weak price levels are very important when it comes to finding good entries and as a result, make better trades. Next up, we're going to talk about something called supply and demand. We will both take a look at the basics of supply and demand, but even more importantly, we will take a look at how you can use supply and demand together with market structure concepts such as strong and weak price levels, change of character, and break of structure. Because it's actually when you combine supply and demand with these other concepts, you can really start to improve your trading. In chapter 5, it's time to cover fair value gaps, or for short, FVG. This right here is a very important smart money concept to understand, and I will go over everything you need to know in a simple, step-by-step manner. Last but definitely not least, we are going to talk about liquidity grabs. This right here is one of my personal favorite concepts. And when you master it, you will both be able to take better trades, but you will also be able to avoid many of the false signals. But alright guys, so let's begin here by super quickly taking a look at what is smart money concepts, or SMC. And in very simple terms, smart money concepts are trading strategies used by the smart money. And what do we mean when we talk about smart money? Well, smart money are basically knowledgeable financial professionals. Like for example, banks such as Goldman Sachs or JP Morgan, hedge funds like for example Bridgewater. And that is why I have this image right here. Many of you guys are probably familiar with him. This right here is Ray Dalio, which is the founder of Bridgewater. And I actually think that Bridgewater is the largest hedge fund in the world. So Dalio and his hedge fund is a great example of smart money. But we also have other institutional investors, such as mutual funds or pension funds, that are definitely considered smart money. But now then, what are some important characteristics when it comes to smart money? Well, first of all, the most important characteristic here is that smart money have large amounts of capital. And because they have lots of money, they are capable of moving the market. So if we as smaller investors can understand how smart money moves market, we can trade in the same direction as the smart money, and as a result, make more profit. Another important characteristic here is that smart money often have access to more advanced market data. They often have more sophisticated analysis tools compared to retail traders like you and me. Smart money often also have, large teams of highly skilled analysts and traders. And that is of course yet another big advantage of the smart money. Alright, so now when we have a basic understanding of what smart money is and also what smart money concepts is, we are now ready to start learning about smart money concepts. And the very first thing we need to learn about here is something called market structure. So let's begin here by taking a look at some market structure basics. Market structure is basically the analysis of how the market has moved in the past to predict how the market will move in the future. And the first thing we have to learn here is that the market can be in 3 states. The first market state is the uptrend. And we know that the market is in an uptrend if the market consistently breaks higher highs while at the same time prints higher lows. So if you take a look right here, we can see an example of an uptrend. You can see that the market here is both printing consecutive higher highs while at the same time printing consecutive higher lows. As long as the market keeps on printing higher highs and higher lows, we are in an uptrend. And very soon we will dive deeper into analyzing uptrends, but so far this is all you need to know. The next state the market can be in is a downtrend, and this is basically the opposite of the uptrend. So in order to have a downtrend, the market needs to consistently break to lower lows while at the same time staying above the highs. So right here we have an example of a downtrend. As you can see, this market prints consecutive lower highs while at the same time printing consecutive lower lows. And the final state a market can be in is a sideways market, or in other words, a trading range. And a trading range is very simple. That is a market that moves sideways without a clear uptrend or downtrend. So right here we have an example of a sideways market. You can see in this case we have the highs here at the same level and the lows at the same level. But a sideways market can also be a market that looks something like this. For example, right here you can see that the market is printing higher highs, but it's also printing a lower low. And then it prints a lower highs and lows here at around the same level. So a trading range doesn't have to be perfectly straight with highs and lows at the same level. It can basically be any kind of market that are not in a clear uptrend or downtrend. And now let's take a look at the uptrend, downtrend and sideways market a bit more in detail. Because this image I just recently showed you guys is actually a bit flawed. And let's begin here by analyzing the uptrend. Remember from earlier that in order to have an uptrend, we need to print higher highs and higher lows. And what we actually can see on this image is that we are printing a higher high right here, a higher high right here, but right here, this is yet another higher high. So the color of that circle should actually be a green one because we are still in an uptrend at this point. We can also see that we have a low, we have a higher low, but this right here is yet another higher low. So the market at this point in time is still in an uptrend. But now let's focus on this point right here. This is a very important point because this is the point where the market fails to break to a higher high. So at this point, we can consider that the market has entered a trading range. But one very important thing to consider about trading ranges is that trading ranges are actually very important to exist within uptrends. So it's very possible that we see an uptrend right here. Then for a short while, we see a trading range. We can call this a consolidation or a pullback. This right here is actually often just a pause in the uptrend. And many times after the trading range, the trend will continue in the same direction. Now, last but not least, let's consider when this market has actually entered a downtrend. Well, the first important signal actually comes when the price breaks below this point right here. Because when the price breaks below this point, we will for sure print another lower low. And this break right here is very important, and we will talk about that later on in this course. But for now, we just need to realize that when the price breaks below this point, we will for certain print a lower low. But remember here that in order to have a downtrend, we need to have both lower highs and lower lows. So it's not until we print this high right here that we actually have two lower highs and two lower lows. So it's basically at this point the real sort of trend is confirmed. Alright, so now when you know the basics about uptrends, downtrends and sideways markets, now we are finally ready to take a look at change of character or CHOCH and break of structure or BOS. And let's begin here by taking a look at break of structure. A break of structure occurs when the price breaks a higher high within an uptrend or a lower low within a downtrend. So for example, right here, you can see that this market is in an uptrend. And when the price pushes above this point right here, so at this point right here, the price breaks to a new high within an uptrend, and therefore this is a break of structure, or for short BOS. When we're talking about the break of structures in uptrend, we can call this a bullish break of structure. And the same thing actually happens right here. You can see at this point the price breaks to yet another higher high. So here we have yet another break of structure. But now, as you can see right here, this high actually never got broken. So we saw no more breaks of structure in this uptrend. Instead, let's focus on this low right here. When the price pushes below the most recent low in an uptrend, we call this a change of character, or for short CHOCH. And as we can hear on the name, a change of character basically means that the character of the price, which is currently in an uptrend, is changing. So a change of character is a first warning sign you.